Hello everybody, and today we will talk about moving average and RSI oscillator, the most common indicator and oscillator in technical analysis. They will help you to analyze the charts. The moving average is a simple technical analysis tool that smooths out the price data by creating constantly updated average price. The average is taken over a specific period of time, like 10 days, 20 minutes, 30 weeks, or any time period the trader chooses. The advantages of using a moving average in your trading, as well as options on that type of moving average to use. Moving average strategies are also popular and can be tailored to any time frame, suiting both long-term investors and short-term traders. A moving average helps cut down the amount of noise on a price chart. Charting software and trading platforms do the calculation, so no manual math is required to use a moving average. A moving average can also act as support or resistance. In uptrend, a 50-day, 100-day, or 200-day moving average may act as a support level, as shown on the figure. This is because the average acts like a floor or support, so the price bounces up of it. In downtrend, a moving average may act as a resistance, like a selling the price hit the level and then start to drop again. The price won't always respect the moving average in this way. The price may run throughout it significantly or stop and reverse prior to reaching it. If the price is below a moving average, the trend is down. However, moving average can have different lengths, so one moving average may indicate an uptrend, while another indicates a downtrend. And moving average can be calculated in different ways. A 5-day simple moving average as the 5 most recent daily closing prices and divided into 5 to create a new average each day. Each average is connected to the next, creating a singular flowing line. Another popular type of moving average is exponential moving average. The calculation is more complex as it applies more weight of the most recent prices. If you plot a 50-day simple moving average and 50-day exponential moving average on the same chart, you will notice that the exponential moving average reacts more quickly to the price changes than this simple moving average does, due to the additional weight on recent price data. Common moving average lengths are 10, 20, 50, 100, and 200. These lengths can be applied to any chart time frame, depending on the trader's time horizon. The time frame or length you choose for a moving average, also called the look-back period, can play a big role in how effective it is. And moving average with this short time frame will react much quicker, no price changes, than a moving average with a long look-back period. In the figure, the 20-day moving average more closely tracks the actual price than 100-day moving average does. The 20-day may be of an analytical benefit to a short-term trader since it follows the price more closely and therefore produces less lag. Long-term moving average. A 100-day moving average can be more beneficial to a longer time period trader. Lag is the time it takes for a moving average to signal a potential reversal. Recall that, as a general guidance, when the price is above a moving average, the trend is considered up. So when the price drops below that moving average, it signals a potential reversal based on that moving average. A 20-day moving average will provide many more reversal signals than 100-day moving average. They can be any length, 15, 28, 19, 8, etc., adjusting the moving average so it provides more accurate signals on historical data may help create better figure signals. Crossovers are one of the main moving average strategies. The first type is a price crossover, which then the price crosses above or below the moving average, so signal a potential change in trend. Another strategy is to apply two moving averages to a chart, one longer and one shorter. When the short-term moving average crosses above the long-term moving average, it's a buy signal, as it indicates that the trend is shifting up. This is known as a golden cross. Meanwhile, when the short-term moving average crosses below the longer-term moving average, it's sell signal, as it indicates that the trend is shifting down. This is known as death or dead cross. So how can we insert the indicator in our chart? Let's take a look on Euro USD chart. So to insert it, we need to choose Insert an MT5 trading platform and choose Indicators. Then we can see that we have as a default moving average, but you also can find it in trend, and then you need to choose moving average. Let's set, for example, period of time 5 days. It would be for example, green line, as we can see, that is on the chart. And then we will insert one more moving average, for example, for the period of 20 days. As we can see, let's make it another color for us to indicate it more proper. So as we can see on the chart, once a time the moving average for 5 days crossed the moving average of 20 days. Top down cross. So that is a signal for a selling, also known as a dead cross. So moving average simplifies price data by smoothing out and creating one flowing line. A moving average simplifies price data by smoothing out and creating a new flowing line. This makes seeing the trend easier. Exponential moving average react quicker to price changes than simple moving average. In some cases, this may be good, and in others it may cause false signals. Moving average with the shorter look-back period will also respond quicker to price changes than average with the longer look-back period. Moving average crossovers are a popular strategy for both entries and exits. Moving averages can also highlight areas of potential support or resistance. While these may appear predictive, moving averages are always based on historical data and simply show the average price over a certain time period. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. The indicator was originally developed by Wells Wilder and introduced in his seminal 1978 book, New Concepts in Technical Trading System. Traditional interpretation and usage of RSI are that values of 70 or above indicate that a security is becoming overbought or overvalued and may be primed for a trend reversal or collective pullback in price. RSI reading of 30 or below indicates an oversold or undervalued condition. The relative strength index is computed with a two-part calculation that starts with the following formula. The average gain or loss used in the calculation is the average percentage gain or loss during lookback period. The formula uses as positive value for the average loss. The standard is to use 14 periods to calculate the initial RSI value. For example, Imagine the market closed higher 7 out of the past 14 days with an average gain of 1%. The remaining 7 days all closed lower with the all average loss of minus 0.8%. The calculation for the first part of the RSI would look like the following explained calculation. 55.55 equals 100 minus the formula. Once there are 14 periods of data available, the second part of the RSI formula can be calculated. The second step of the calculation smooths the results. Using this formula, RCI can be calculated where the RCI line can then be plotted beneath an asset price chart. It will rise as the number and size of positive closes increase, and it will fall as the number of size of losses increase. The second part of the calculation smooths the results, so the RSI will only near 100 or 0 in a strongly trading market. As you can see in the chart, the RSI indicator can stay in the overbought region for extended periods while the stock is in an uptrend. The indicator may also remain in the oversold territory for a long time when the stock is in a downtrend. This can be confusing for a new analyst, but learning to use the indicator within the context of the prevailing trend will clarify these issues. As you can see in the following chart, during a downtrend, the RSI would peak near 50% level rather than 70%, which could be used by investors to more reliability signal bearish conditions. Many investors will apply a horizontal trend line that is between 30 and 70% levels when a strong trend is in place to better identify extremes. Modifying overbought or oversold levels when the price of a stock or asset is in a long-term horizontal channel is usually unnecessary. Related to concept to using overbought or oversold levels appropriate to the trend is a focus on trading signals and techniques that conform to the trend. In other words, using bullish signals when the price is in a bullish trend and bearish signals when the stock is in a bearish trend will help to avoid the many false alarms the RSI can generate. A bullish divergence occurs, then RSI creates an oversold reading followed by a higher low that matches correspondingly a lower lows in the price. This indicates rise in a bullish momentum, and a break above oversold territory could be used to trigger a new long position. As you can see in the following chart, a bearish divergence was identified when the RSI formed higher lows and the price formed lower lows. This was a valid signal, but divergence can be rare when the stock is in a stable long-term trade. Using flexible oversold or overbought readings will help identify more potential signals. Another trading technique examines RSI's behavior when it's emerging from the overbought or oversold territory. This signal is called a bullish swing rejection and has 4 parts. As you can see, the first is RSI falls into oversold territory. Second, crosses back above 30%. Third one forms another dip throughout crossing back into oversold territory. And the fourth, when breaks its most recent height. So the RSI indicator was oversold, broke up throughout 30% and formed the rejection low that triggers the signal when it bounces higher. Using RSI in this way is very similar to drawing trend lines on the price chart. Like divergences, there are a bearish version of this swing rejection signal that looks like a mirror image of the bullish version. A bearish swing rejection also has four parts. The first one rises into overbought territory. Second, crosses back below 70%. Third one forms another height without crossing back into overbought territory. And fourth one, RSI then breaks its most recent low. Bearish signals during downward trends are less likely to generate false alarms. So we can use RSI to pick potential tops and bottoms depending on whether the market is overbought or oversold. You can see a 4-hour chart Euro USD. Euro USD had been dropping in the week, falling about 400 pips over the course of 2 weeks. On June 7th, it was already trading below the 1.2000 handle. However, RSI dropped below 30%, signaling that might be no more sellers left in the market and there more could be over. Price was reversed and headed back up over the next couple of weeks. In order to find it in the trading platform and insert in your chart, you should choose Insert, Indicators, and then you may find RSI in the Custom button. So press on it, and then, as you can see, it may be inserted. For today, that is all. Thank you so much for your attention. Wish you great trades and stay safe.